Hi, I'm Lois Basil, a member of the Alliance of Comprehensive Planners, and I'm very honored today to be having a conversation with Mr. John Bogle. He's letting me call him Jack as well. Thank you so much for spending time with us today at our conference and for this opportunity for us to get to know you. Can you tell us a little bit about Vanguard?
Sure. To answer your question, first of all, we're 40 years old. We just had our 40th anniversary, and we started with a totally different way of looking at the mutual fund industry. We decided funds should be run for their investors and not for their managers. So what we created in Vanguard was a mutual company in which the shareholders of the funds essentially own the company. Actually, factually speaking, the mutual funds themselves each own shares in Vanguard, and the funds are then owned by individual shareholders. So we operate at cost. There's no profit involved in Vanguard. It's a cost-sharing arrangement. And that eliminates one of the great conflicts in the mutual fund business, which is often that not only they're private owners of management companies, which is not the end of the world, that want to make a profit, but also public owners, including financial conglomerates. And they're in business to make money for themselves. Capitalism is that way, and we're in business to make money for the shareholders. So we started out with a huge hedge, tiny. We were running $1.4 billion, and we had 28 crew members, as we call them at Vanguard, and it was a big fight. Half of our, 30% of our capital was withdrawn in the first 3 years, $400 million of the $400 million of the $1.4 billion, and and the market just hit its low at the moment we started almost. The big bear market of 1973, 1974, another 50% decline. We're getting used to it.
You're getting used to it. And so you had the foresight to say we're going to ride this out because I really believe in this style of investing.
Well, actually, it's much more than that. I believe in the mathematics, and that is, if you can operate at the lowest cost, be the lowest cost provider in the business, as everybody must know by now, the returns that are delivered in the market are shared by all investors in a 7% market, and we all get 7%, all of us together, and you take out a tiny cost, and you may get 6.9%, and take out a big cost, and you get 5%. So you have the mathematics on your side. You are the lowest we would become. It took a little while, maybe 10 years, to become the lowest cost provider. And now we are so far below everybody else, our costs come to about 15 basis points, 0.15 of 1% per year, and the typical management company operates at maybe a full percentage point higher than that. So we're the low cost provider in an industry where cost is everything globally.
Absolutely.
And where nobody wants to compete with us. Sometimes they have to be dragged kicking and screaming into the competition, but they don't like it, because the more our peers, if there are such, the more they lower their costs, the less their profits are.
Exactly. But we agree that I think that's one of the biggest factors in investing is at the lowest possible cost. What do you think of organizations like ours, the Alliance of Comprehensive Planners?
Well, first of all, I've worked with a lot of financial planners, RIAs, registered investment advisors, over many, many years, pretty much all of my career. Although at the beginning, interestingly, they were all stockbrokers, because we had been distributed by stockbrokers all over the country from 1928 with Wellington Fund all the way up to 1977. And we abandoned that system overnight, eliminated all sales commissions, and our brokers were not happy.
I was going to say that I wouldn't know if I wanted to be in that meeting. How did you do that? How did you convince
Well, first,
them?
I was never at a meeting. I mean, I had to persuade the board.
Right.
And they were very reluctant to do it. But finally, I just wore them down, to be honest with you. And we did it. We took our chances. And we were losing assets. We were losing market share. We had to go on a whole new course that was consistent with operating the funds at a low cost. I mean, how can you have an 8% sales commission, sales load as they're called, and say we're the low cost provider? So you've got to be consistent. So, and that was done quickly. It amazed the industry. Our competitors were advertising that they would not go no load, believe it or not. Dreyfus advertised.
They were advertising that?
Well, they were telling their dealers, no load, no way, was what one of the Dreyfus ads said. They went no load years later, of course.
Of course they did, of course they did.
So that was a very important part of it. And it was then that I began to work with the registered RIAs rather than the brokers.
Okay.
The brokers were not happy with me, of course, and I feel badly about that, actually. And the wholesalers that lost their jobs, I feel badly about that, too. But you got to move on. And so I always thought from the very beginning that Vanguard was a great fit for the typical IRA. Why? Because if they're charging 1%, and you can argue that's a little high, you can argue anything you want, but added to a fund's 1.2%, their client is paying 2.2% a year. So if they go with us, they can still charge their 1%, and the client is paying 1.2% a year, or 1.1% a year. So it made sense. We were natural partners. We did not do, for quite a few years, an entry into that field that was very aggressive. I think some of the people in the firm, not me, because I used to talk to financial planning associations and things like that, and they always welcomed me. But it was a natural fit. As we gradually developed indexing as the dominant part of our business opportunities, we became more and more accepted. The cost went down and down, and so it took a long time to build all that, and a difficult time. But working with advisors has been important to me. I have said many times, and the reason I like your structure here is I've always said, sometimes with mixed reactions from the audience, that a flat fee is not necessarily the best advice, and that I thought it would best advice for running a business and for serving your clients. And I thought the industry financial planning industry would morph to fee only, and fees being based on maybe an annual retainer or an annual or a hourly fee for service.
Well, here at the Alliance of Comprehensive Planners, we have certainly made the retainer model work for us very well, and I'm glad that you can see that.
Well, that's probably because it works for your clients.
Exactly, it works for our clients.
And as I tell people, that's important too.
It works for our clients, and it works for us as business owners, and it's a win-win for everyone.
Yeah.
And having the opportunities to be in low-cost funds such as Vanguard offers is an amazing thing for us as advisors.
It's a huge thing. It's a lifetime. You know, if you look at investing as a lifetime process, it goes on for a young person today. It's going to go on probably for 80 years. Today's 20-year-old is going to live to 100.
Absolutely.
I feel kind of sorry for them, but that's beside the point.
Right, exactly. And that's a challenge for us as advisors to help them say, let's help you create the life you want to lead. And we can do that pretty simply. Spend less than you make, invest at the lowest possible cost in a proper asset allocation. Done.
That's it.
Yeah, that's it.
And you will get your fair share of the market return in any section of the market, stocks, bonds, or anything else that you choose.
Right.
And there's no way around it.
There's no way around it.
That's the only promise that's reliable in the entire mutual fund industry, I think.
Exactly. The hard part is to shut out the noise from everyone else.
Yep. We like noise.
Yeah. Well,
stupidly.
We do like noise, and sometimes it's hard to get our clients to shut out the noise. And
they're watching the market goes down. Oh my God, what am I going to do today? You know this better than I do.
Right, exactly. And
nothing is always the answer.
I say, what can we control today?
Yeah.
You're saving and you're spending. We don't care about the markets.
Yeah.
We just want to be in the markets at the right asset allocation. Have you noticed any trends recently in financial planning?
Well, I'm not so sure about the data that gets collected. There's not, as far as I can tell, a really reliable source of data. But it seems to be moving, in my observations, anecdotal observations, definitely away from stockbrokers, the Merrill Lynch's and so on down the line, and toward, often because salesmen, account executives, whatever they are, often will leave those, get tired of those big firms, and start their own financial planning. So I think that is a direction. It's hard for me to tell how far it's gone. I suspect it has gone a decent way, but not nearly as far as it will go. So the brokerage model is a very difficult, bad model, because they have to sell something. You know,
Exactly.
if a salesman doesn't sell anything all month, comes home on the last day of the month, his check is going to have 0, 0, 0, 0 written on it.
Right, right. And his skin is really in the game, so guess what that broker's going to do? They're going to sell, 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 whether it's in your best interest or not.
I mean, they're going to believe it is. I mean,
Of course
I
they
don't
are.
impugn their motives, but their firm is going to be an underwriter for a new issue, and they're going to take the firm's word for it. This is a great company. Some are, some are not, but they all get sold.
Right, exactly. Very good. Well, I thank you so much for your time with us today, and I know that our members are really looking forward to your talk later on.
Well, thank you so much.
Thank
It's
you
been fun
very
chatting
much.
with you.
Thank you.
And good luck.
Thank you very much.